Hello, friends, and welcome to another interesting episode of Lessons from the Masters, brought to you by Aditya Birla Sun Life Mutual Funds. Friends, a solid business is something that relies on processes to acquire and retain clients, yields consistent profits, and builds a strong team. So, considering the hyper competitive MFD business and deferred income stream through trail commission, many MFDs would like to understand what it takes to create a solid business model. To address this question, today we have with us Mr. Bharat Phatak, Director and Promoter, Wealth Managers India. Bharat, a chartered accountant by qualification, is an accomplished investment professional and possesses in-depth knowledge of Indian securities markets. He runs one of the largest mutual fund distribution companies in India. Bharat will be in conversation with Mr. KS Rao, Head Investor Education and Distribution Development at Aditya Birla Sun Life Mutual Fund. KS, as we all know, is synonymous with education of investors and distributors. In fact, under his leadership, his fund house has won Asia Asset Management Award for the fifth time in the area of investor education. So, without wasting a single minute, let me welcome Bharat and KS. Over to you, Mr. KS.
Thank you so much, Nishant, and great to be with Bharatji this evening. Good evening, friends. Indeed, glad to have you all this evening for a very interesting session. Lot to learn, and it's always, learning from the masters. And what we can learn from the masters, every minute, every bit, we can learn something. How we can get an inspiration, how we can get an insight, how we can implement those insights into our things. And today it is about the business model. Who can talk to us other than the Bharatji for on the business model, because of the not only success story, because of the journey of 30 years. It's a 1991 to till date. It's a 30 years of rich experience, and 30 years we have seen from Arshad Mehta days to till date. I mean, somebody who started a career during Arshad Mehta's period, and today it is a like growing business. Let us make little engaging. Uh, you know. Uh, Before I start my conversation, let us use chart for a minute. Anyone can roughly guess what could be the um, assets under management, Bharatji's team, and managed from wealth managers. Any rough guess? Wow, 1,000 crores and fantastic. 2005, Rajesh Quatra 5,000 crores and Manish says 1,500, Ravikant 5,000. I think the answer paper looks out, and it is a 5,000 crores of assets of mutual funds. But beyond that, there is other assets together. It's almost a 7,000. Probably in a year later, if we are connecting with Bharatji, we can see something around 10,000 crores. Definitely, some of you have mentioned that will come true. With this, I will not waste much of time, and I sincerely thank Bharatji for few things. Not only he is keen to share, and he's always and he is who always most respected in the industry, and most aspect of it is so silent, but at the same time, is so humble in spite of all the success. And I am grateful to you, Bharatji. Namaskar, and thank you so much for being here. And today he has also taken little pain on his way back from Mumbai to Pune. On path, he is parked for us at a park, and he is connecting to us. And it's going to be a very interesting conversations. Let us look at. Let me give one more introduction in addition to what Nishant said. Bharatji is a chartered accountant by qualification. He had his partner, Mr. Ajit and Bharatji, established this wealth managers, and they are now one of those leading and most respected investment company. And incidentally, their corporate office building name is called Kamadhenu, which creates the wealth for everyone. And and accidentally, I do not know, but they have one branch in Pune. It is at Income Tax Road. Probably, if we are getting out of the tax roads, then you create a wealth that is Kamadhenu, which comes to you. With this, I'll stop, and Bharatji, over to you, and kindly share. I mean, it's a phenomenal journey to learn. 30 years of a journey, and you are successful child accountant, and you had a corporate experience, and after leaving the practicing consultancy, and with that such rich experience, and that too at the moment of 91, and you are into the business of capital markets and broking, then to the mutual funds. If you can share your journey a bit, then we can move to the business models later.
Okay. Uh, Good evening, friends. Am I audible?
Yes, sir, you are audible, sir.
Thank you so much. Uh, We started with the AUM number, and this reminded me of a story. Two shepherds meet where they have got their cattle to graze. And one says that I have got 500 cows and I have got them for grazing. Second says, oh, you are nothing. I have got 800 cows and I have got them for grazing. Without realizing that this is all other people's cows and our job is only as a shepherd. So we bring them from home and we return them home. So as long as they are safe, our job is done. So take this AUM numbers with a pinch of salt. I remember when we started our business and we reached our first number of collection in company FDs those days to 10 lakhs, we had celebrated in our office. So all of us start small, and even if you have a boring journey, over 30 years you will collect a large number of assets. So I'm sure all the participants here will be able to do that if they stick to what they are doing with conviction and passion and with focus. I qualified as a chartered accountant in 82. I joined my father's practice as in the conventional tax and audit work. But in 10 years, I realized, it took me 10 years to realize that this is not something which I really enjoy doing. And the investment field was opening up at that time. India as a country was opening up. The privatization was taking place. License quota permit was being removed. And there was big expectation from India. So I said, this is the time to, take the plunge and go into what I really enjoy. So that is where I gave up my certificate of practice and started full-time as a sub-broker in Pune Stock Exchange. After that, in 1994, some of us friends, we got together and formed a company to take membership of the National Stock Exchange, which was an emerging thing at that time. I was interested in mutual funds since the very beginning. Even in 91, we had these issues like UTI Master Plus, UTI Master Gain. 94, we saw Morgan Stanley Growth Fund. And you'll be surprised, but these funds raised more than $1 billion in those days. So so that got me interested, but I think the real credit for whatever journey we got onto goes to Birla Mutual Fund. And I'm not saying this because Mr. KS Rao is here, but Birla Mutual Fund was one of the first private sector mutual funds in the country, and they introduced the concept of fixed income or debt funds. And Birla Income Funds issue, we realized that this is an alternate asset which can give a significant tax efficient return to the investors. Because of my background as in taxation, I realized that this was a way in which interest could be converted into capital gains and significant tax could be saved on that. So you'll be surprised in those days, AAA rated companies like Grasim and L&T, Tisco used to give 16 to 18% rate of interest. And if you could, save the tax on that, it worked to an effective IRR of 25%. Effective pre-tax IRR of 25%. So, today all of us chase private equity funds with the hope that we'll get a 25% IRR. So, that was the beginning, and we could take this to a number of corporate treasuries, and they found a lot of value in that. So, like the 10 lakh rupee collection, we saw our first 1 crore check for Birla Income Plus sometime in 1996. So this had two effects. We could our mind got accustomed to larger numbers, but also our mind got accustomed to trail income. So our business was never built on upfront commissions. So Birla Cash Plus also people stayed there for 15 days, 20 days, 30 days. We used to earn an annualized commission, which was a small number, but this also kept the expectations in place as far as our practice model was concerned. And from 2001, Ajit Khasnis, my partner, who is also a CA, we exited broking and started full time into mutual funds. In 2006, we also got the PMS license. 2015, we got the RI license under the company because it's a corporate entity. We are doing distribution, PMS, and RI under the same company. And the focus of the business started shifting from 2001 away from corporates into the HNI, ultra HNI space. And the reason for this was we realized that even HNIs were looking for tax efficient returns. So it was essentially focused on tax conscious people, and we could help them get more tax efficient returns. Then we warmed up to equity, and God has been kind because the period from 2003 to 2007 was very positive for equities. The BSE Sensex went from 3,000 to 21,000 in those days. So that reminds me of an old stock market saying that Khuda Meherban to Gada Pehlwan. So the tide was in our favor, and that helped to a large extent. But some of the things we followed even in those days. In that period of 4 years, there were 42 IPOs. NFOs were called IPOs in those days. But we did not sell any of the IPOs. We sold out of those 42 only 3 IPOs. And you will find that IPOs gave a 6% entry load, and they gave very high 4 or 5% commission in those days. But we thought this is not something which is going to benefit the investor, so we will not do it. Also, typically, NFOs are launched when a particular sector has done well, and we thought it was a time to avoid those rather than encourage those. Out of the 3 NFOs that we took to clients, one of the very successful scheme for us was Birla Yield Plus and Birla Dividend Yield Plus, and those were the times when the value sector was very depressed, and companies with good dividend yield helped clients to get that. I'm getting a message from Mr. Srivastava that there is an echo. So,
no, I think Dhirendra Srivastava, please check at your end. Echo is very much. Ankit, I think here it is coming well. Any case, yeah, we'll try once again. Sir, you can go proceed.
Right. So, broadly, this has been the journey, but some of the things we have always done ahead of times, in the sense looking at what is beneficial to the investors. So I told about NFOs. Also, before the entry load was removed and a direct plan without entry load was introduced, we gave that plan to most of the investors. Then when the upfront commission was stopped, we had moved to trail commission even before that. So, I mean, internally, if you see what is beneficial to the investor and stick to that, we have found that it may mean a short-term sacrifice, but it leads to a long-term gain.
Fabulous, sir. In fact, very interesting, and you are true to your words. When somebody visits your website, it's like, the company background, and later if you can go and what you can see, what you said is right, invest for maximum total returns. And it's always your business is evolved. I'm so thankful, for you start. Of course, in the fixed income story, Birla Income plus Birla Cash was the story to look at. And thanks for mentioning that. And very honored. And a couple of things I would like to learn. I mean, it's a long journey. Uh, uh, like uh, Hope you all get that echo is off and now things are okay, and some of you are feeling that echo maybe at I'm not seeing that here, but Ankit ji just check once, and Dhirendra said now it's fine. We will continue the conversation as much as possible. I think it's fine. Yogesh, thanks for that conversation. And sir, and good looking back, I think this is the story which is evolved over, and the business model which is looked at very differently, and you have seen so many ups and downs. It's a in the market as well as all models which are changing, but your focus has never got deviated. And I also have seen a couple of things, apart from what you mentioned, invest for maximum total returns, and your vision and mission very clearly you mentioned about protect and grow wealth of clients. That's where the client's business is client's wealth is growing, and as the wealth managers funds also growing. Would you like to share the business model which has evolved over a period, and what are few things which is work for you? And probably if you want to use your slides, we can look forward. That can give a lot more clarity to the audience.
Right. Uh, so, I mean, one of the first questions that we have to face is whether this is a business or this is a professional practice. So, should we be referring to this as a practice model rather than a business model? And I believe for mutual fund distributors or RIAs or investment professionals who are connected to the last mile, or for whom there is a face to the money. So when a fund manager manages it, he looks at the portfolio. But when we manage money, we have to look at the face of the client and his wife, because both of them will have different opinions, and we'll have to understand their concerns, their psychology, and we have to build this trust over a period of time. So typically we will find that it is our contacts, efforts, and skills of an individual which work. Even in a partnership firm, it is the collective contact, effort, skills of different team members which will work. But as MFDs or as advisors, we connect to the client, his family, his psychology, his financial situation, his concerns. And I think that is a very key, important part in structuring your business. Let's face it, it is face time and face value, which is very important. So, not only should I have concern for my clients, but I should make sure that it is communicated to them. Clients need somebody to listen to them and understand their concerns. So, instead of speaking a lot, we have to learn to listen a lot and also read between the lines. So, for that, it is important to spend time and look at this more as a consulting practice. So fund managers are doing a good job creating good funds, but taking the appropriate funds and implementing them in the client's portfolio is an important part. And that is why we have to look at this as more as a consulting practice than a distribution business. So I think that is first part. I'll share the screen, and we'll look at some of the peculiarities of professional service firm and the practice model.
Sure, sir. That would be great help. And friends, any questions you have, please put it in Q&A. At the maybe next 20-25 minutes, we start those questions. And over to you, sir. Growth with prudence.
Is it visible?
Yeah, it's visible. It's visible. Yeah. Very much visible.
So most of us ask the question, how can I be successful? And the right question to ask. Peter Drucker says, do not ask how can I be successful, ask how can I be useful. Meaning, am I creating value for my clients? And that value creation, value proposition which I have. They're understanding the concerns and creating a portfolio for clients which will help them to achieve their goals in a undisturbed, smooth fashion over long periods of time. This is where my value proposition will start becoming important to myself and to my clients. So I think each of us will have a model which is different. Each of us will be working in different circumstances, different client segments. But the first question always to ask is, am I creating value? Am I useful to clients? And then the mission statement for any service firm, whether it is a law firm, whether an architectural firm, CA firm, can be summarized in three parts. What clients want is performance and service. What employees and team members want is satisfaction and growth. And what owners want is profit and recognition. So when I say that what is my mission, it is happy clients, happy employees, and happy professional or happy owner. So are we doing that? And is my current service model, practice model, answering all these three is an important part. At different stages in your practice, you will have a different type of organization. And initially, I believe it is always the power of one. So from the lowest to the highest level in the organization, there is only one person. But don't look at this as a disadvantage. I mean, some people feel that, oh, I have to fill the forms, I have to do this, I have to take it to the front office, I have to write the checks, I have to go to the clients. But you will also realize that when the practice is small, doing all these things yourself, saves you time, saves you cost, and you learn everything from grassroots or from ground up. So tomorrow when you are going to have a larger team, many of these problems you have solved yourself, and you can solve those problems for your team members. So also the speed of decision in a single person office is very fast. We say this is like a water scooter or a speedboat. You can take and execute decisions very fast. When the organization becomes big, it becomes like a super tanker. It will take 2 hours to change your direction, but as a single person, you can run circles around that because of your speed. So there is a great advantage, and this is a great learning ground for all professionals, having done everything in their office themselves. But as the business starts growing, the next set of challenges comes, and this is what we call buying time. And many of us hesitate to take more people on board. We want to save on costs, and we say, oh, can I give 15,000 rupees to this person? Is he worth it? Now look at it this way, that by taking somebody on board for 15,000 rupees a month, does that add 2 hours to your time per day? And if that adds 2 hours per day to your time, the time that you can spend on the research, time that you can spend with clients, then actually you are not costing their time, you are costing your own time. So are 2 hours every day of your time worth 15,000 rupees, rather than saying, is this person worth 15,000 rupees for 8 hours? So I think we are buying time from somebody else who will be much less skilled, much less experienced, much less knowledgeable than you. But if it creates more time for you, that starts becoming important. And then we come to the next stage, advantages of coming together. So this is an illustration of specialization. You look at a chartered accountant's practice. As the firm starts growing, one partner says that I will focus on tax, my partner will focus on audit. After a point, they may say that one will focus on GST, one will focus on income tax. The other two partners will say, I will focus on internal audit, somebody will focus on statutory audit. And that allows you to go into depth of that subject. But at the same time, you have a backup plan where other partners are taking responsibilities in other areas. And this is what creates synergy. So as in a cricket team, there are specialized bowlers, specialized batsmen, and specialized wicketkeeper. The wicketkeeper can also bat. The bowler can also come as a night watchman. But because he specializes in a particular job, it becomes helpful. And this creates synergy. So I'm saying 1 plus 1 can become 3 if we specialize. So there are definitely advantages of coming together. There are 3 kinds of client work that we look at, and I'll take a little time in explaining this. There are certain areas in which we are trying to do path-breaking work, very innovative work. We are experimenting here. So when we look at expertise and innovation, it is something where I may not be making a lot of money, but I'm doing things which are new. So when we spoke of our example of instead of Unit 64 proposing Birla Income Plus, it meant that if I just sold Unit 64, I would have made more money. But when I studied and when I tried to give a new tax efficient instrument, it meant that for that effort, I made no money. But over a period of time, it transfers from expertise to experience. If you have done something good and you have implemented it in a number of clients, then people start appreciating that and they see the results of your other clients, their friends, and then they start saying that, oh, let me go to somebody who knows this, who has done it before. I'll give you an example of a surgery. If somebody says that I have developed a new technique of knee replacement surgery, it will save the time or it will give more benefit. Some people are willing to go through that experiment, but most of them will say that no, let me go to somebody who has done 2000 surgeries, 3000 surgeries. So after innovation comes experience and gray hair, and this is the part of the practice which is a cash cow. So you will make more money by repeating things that you have innovated and doing them again and again and again, so that people know that they are not guinea pigs. You are doing something at which you are good. But also please remember that something which was new 10 years ago is no longer new. And then with a lot of experience also, it is something that anybody can do. It can become a commodity. And that is where that product now will be decided by efficiency. So it will be done by lower cost, higher speed, better quality, but it will become a commodity. And then if my organization is efficient, instead of writing forms, I'm using the digital way, online way of making transactions that can add efficiency, that can allow me to give more output. So from experience to efficiency, something which anybody can do, but I can do faster, cheaper, at better quality. And this is where you will find that many of the fintechs are coming into this picture, that if I have to give only an SIP blindly, then a fintech can do it much faster, cheaper. So all products or all service areas pass through this transition of expertise, experience, and efficiency. as one thing transfers from expertise to experience, new things must be tried out, and the expertise must be developed in newer area within the same focus. But I mean, today you will find that very few of the distributors will be offering REITs to their clients, because for us there is no commission in there. There is no revenue model. But if there, we don't understand REITs to that extent. If we go deeper, if we understand REITs and we give REITs to our clients, if they benefit from that, we would have collected the valuable experience and we would have added more value to the client. So I think these three kinds of client work are very important. One rough and read test which many of us will find quite useful is what is my resultant billing time. So that in a way is an indication of the value that I am creating or the service, how it is to be built. And this is done simply by taking my total revenue and dividing it by the number of man hours. So all my employees, if each employee and each partner works 2000 hours a year, and we are a team of 5, then 10,000. If our total revenue is 20 lakhs, then 20 lakhs divided by 10,000 will give me my per hour billing rate. This is my effective billing rate. This is not to say that I have to charge clients at that rate, but it gives me an indication that what is it that I'm looking for and how can I go up the value chain. So what will help me to take my billing rate from 200 to 300? Is it adding more members? Is it trying to look at different products? So this is a very rough and read test, but I find it can be very useful when you think about your own practice model. The other important part in a professional service model is where you get your team members from, where you get your employees from, how do you train them. And this training part, there are two aspects. One is the know-how, other is the show-how. So most people don't learn from what they hear, but they learn from what they see. And how you behave with clients, how you take care of the clients, how you help calculate and solve problems for clients. And this is the way most of your next level employees start learning on how they should be doing it. So this has been an old practice in many of the professions. For example, in singing profession, you will find that there is an accomplished singer and he takes on 2-3 disciples, shagirds, who start accompanying him in the different concerts. You will find that the senior of the disciples is given the tanpura. So he will play the tanpura sitting on the stage. And at some times, the singer will allow his disciple to sing a few paltas in that concert. So this is how that training process builds up, and experience and satisfaction working together with the senior partners. So master craftsmen and apprentices, this is how we have to look at it. And if you look at, for example, the CA profession, there are juniors who come in as article clerks. If you look at the law profession, there are junior lawyers who start working with senior lawyers. So I think if we look at our activity as a professional practice, this is a model that you will find quite useful. And as opposed to many other business models depend on feet on street. They expect relationship managers to do most of the selling. And for many of you, the main competition will come from banks. Banks will have many branches, they will have many relationship managers, they have access to client saving accounts, they know how much money is sitting there. But we like to think that we do business only with friends, present or future. Many people say that for friend, you should not do business with friends and relatives. We feel that we should work only for friends, either present or future, which means it has to be a long relationship. And in your competition, you will find that while they are called relationship managers, they change every 6 months, 1 year. So 6 months is not a relationship in my way of thinking. It is the senior person who has to maintain the relationship. I spoke about face time, face value. So lawyers will know it very well that many times face value is more important than case value. And in a lawyer's office, you will find that it is the juniors who work the whole day and prepare the brief and the argument. And the senior partner may read it in 15-20 minutes on his way to the court, but argue it very forcefully in the court. So, in a way, the senior partner is officiating, but the hard work has been done by his juniors. I think similarly, we cannot depend just on feet on street. We have to say that clients want to meet the senior person, and senior person, when he tells something, it becomes far more convincing. The advice given by a senior person is advice that sticks. People find it easier to implement. So, juniors will be doing a lot of technical tasks. Managers will be doing the day-to-day supervision and coordination. But seniors are responsible for marketing and client relations. And I think this is a point which is more important for a professional service firm than a typical business. So this distinction is very important. Traditionally, these are referred to as finders, minders, and grinders. But the minders will become finders, grinders will become minders as they move up within the firm. The more juniors are there, the firm has more leverage. So they will be able to use the time of the senior in a more efficient manner. So this is broadly what I wanted to share as far as the professional service model is concerned. There is another part of this, and I think I can quickly run through that in 5 minutes, which on what principles is your practice based? So for us, we believe that apart from having this care and concern for the clients, it is the principle of asset allocation, which we have found to be extremely useful. So we live in a VUCA world. Volatility, uncertainty, complexity, ambiguity are part of our life. Decisions are always about the future, and future is going to be uncertain. I'll tell you a little joke. One person says that I lost a bet on yesterday's match twice. So his friend asks, how did you lose it twice? So he said, first I bet on the match, I lost. Then I bet on the highlights, I lost again. So when we are dealing with the future, when we are dealing with the markets, we cannot bet on the highlights. We cannot see what has happened, but what is likely to happen, what is the probability. And this is where the principles will come to your help. Client's interest first is the principle that we talked about. We are also faced with the problem of a linear mind in a cyclical world. Most people will think in a linear fashion. In bank FD, they say I'll get 7% return every year, year on year. in stock market I'll get 13% return every year, year on year, and that doesn't happen. In 1 year it will be 27%, in another year it will be minus 5%. And when they apply the bank FD mindset to the stock market, they are confused, they are at a loss to understand this. It is a problem of linear mind in a cyclical world. And if I understand the cycles and if I allocate only that money, which has a longer tenure than the cycle time, that is where I will make the cycle returns. And risk and return, we have to understand, because we have to make clients understand this. And this is the picture of risk and return, which is quite popular. The financial services industry has made this quite popular. Howard Marks says that this is a faulty picture because it shows a nice graph rising towards the right. Higher the risk, higher the return. So this chart talks about risk, but it does not show risk. For it to show the risk, the y-axis has to go below zero, and the risk return chart has to look something like this, that on a 1 year basis, in the last 20 years, there was some time when mid-cap equity funds have given a minus 61% return. Balance funds have given a minus 41% return. And I'm not worried about the good side, that in some years they gave 126% return, that I can forget. It is the downside which is very important, and the next chart will make it very simple. If there is a river which is on an average 5 feet deep, my height is 6 feet and I cannot swim, can I walk across this river? The fact that average depth of that river is 5 feet does not help me. If at some places it is 8 feet deep, it is 10 feet deep, then I am sure to drown in that river. So what salesman will see is fund X CAGR for 24 years is 18.6%. What advisors need to see is on 28th of November 2008, the worst 1 year return was minus 42%. On another date, it was minus 28%. It was minus 16%. And if this is baked into the expectations of the client, that yes, there can be periods over which the returns could be, 1 year returns could be negative. If you have money which can withstand this, and if you can add more money at that time. So I think investment management is more about expectation management, and that is not the fund manager's job, that is the distributors or advisors' job. So this is a different perspective which all of you will find useful. And the asset allocation concept becomes very useful. Debt and equity are the simplest asset allocation tools. You can consider gold, you can consider real estate, you can consider other assets. But it is important to diversify and make a combination of different assets so that the gyrations of those markets are different, the cycles are different, and the clients eventually have a smoother return. However, many people like to think that the returns from an asset allocation portfolio will be inferior. And here I have given one example where you find that pure equity and 75% equity funds, the returns have not been significantly different. And over a 20-year period, both of them have beaten Nifty by a significant margin. These are real-life examples, but they are anecdotal. So I have resisted the temptation of giving the names of these funds. You can find out for yourself. But on a more objective or rational basis, if there is a this same example, pure equity fund and 75% equity fund. What I find is the 75% equity fund has better ratios, lower standard deviation, and possibly returns which are very uh, similar uh, or the same period of time. So since inception, return both 75% equity fund and 100% equity fund have beaten the Nifty by a similar margin. So asset allocation doesn't mean compromising on returns. Asset allocation means taking care of the volatility and giving more peace of mind to the clients. So with that, I think I've run through my presentation. I think you found it useful.
Yeah, it's fantastic. It's a perfect clarity. Thank you so much for that. There are a lot of questions which are coming in. Before I go to the audience questions, I think few questions were focused on the how you acquire clients and how you retain clients. Probably we'll start with that. I think there is a first question, and it's a very interesting conversations which you opened up, and everyone is looking at. This is a question coming from Mr. Vijay Kapta. How did you go about acquiring HNI clients? Probably if you can share something how your client acquisition strategy.
Come again, how did I
What is
go
the how
about
is your client acquisition strategy, sir?
client acquisition strategy? Right. So like I said, it has been largely through reference. So I think your best ambassador is a satisfied client. And the other thing which I said is we work only with friends. So if you also have non-business relations, non-professional relationships with people, that helps. The more people you meet and you do a good job for them, they become your ambassadors. And you must have looked at the concept of net promoter score, NPS, not the pension
Yeah,
scheme, but net promoter score. And in a net promoter score, there is a customer survey, which is a single question which is asked to your existing customers. And that question is, will you refer us to other people? This is a very potent question. Sometimes you will get answers which you don't like. Some people will, tell you some of their shortcomings or where their expectations were not met. So that will help you to improve. For us, it has largely been through word of mouth, and it has largely been through referrals. But in referrals, I think you have to be very, very careful because reference is a twin-edged sword. Especially if you are looking at a particular client segment and you say that for us, a meaningful client relationship will mean X amount in terms of AUM over a period of time. And for that, at what life stage that client will come to us, what income he has. So there is a certain definition of an average client that you make. And then if you blindly ask for reference, people will give references which are not matching with that client profile. Now, you are in a problem because if you follow him, it is not making sense to you. If you don't follow up with that reference, it is an insult to your existing client or the new client, new prospect. So the right way of us looking for references is to find out who are your client's friends out of those who match your criteria. And instead of saying that, will you give me 3 references? You have to say, Nishant, can you introduce me to Mr. Rao because I would like to work for Mr. Rao. So I think this filter, as far as references is concerned, has helped us. to make sure that someone else which Nishant would have introduced to me, I do not unintentionally disrespect or insult him.
Fantastic, sir. And there are questions which are coming. I mean, there are quite a good amount of questions. Mukesh Chathani, MFD software. I think he's talking about efficiency. And just going back, sir, like I mean, I loved the statement which you mentioned in your vision statement, and not only the protecting wealth. There are three ways you put it. You know how you do for your customers. One is excellence in service and client engagement, and second is bringing in efficiency in operations. Third is, we always talk about, just now you spoke about risk adjusted returns and how a RAR works, but your business, your practice management is working on different RAR. That RAR is autonomy and recognition and reward. And if you are to do that, I mean, there is one question which has come in: how to retain, employee retention is becoming a problem. How do I do that? And anything is related here you would like to share?
Yeah, so I mean, to that extent, we have been quite lucky as far as employee retention is concerned. And we have some people who have worked with us for 20 years. And we have seen them grow in their stature. So they are doing a much more valuable job today than the day they joined us. So that potential, they have been able to realize that. And we have seen that there have been two parts to this. One is to give more and more responsibility or more challenges. So if people find interesting work, they get engaged into it. Again, this has to be calibrated. If it becomes too challenging, then it is stressful. And if it is less challenging, then it is boring. So we have to walk the golden mean or the middle path in this, that give a challenge, step by step increase that challenge. Don't give such a big challenge on day one that they will find it frustrating. Secondly, when they meet that challenge, two things are important. One is appreciation, and second is reward. So Einstein has the formula E is equal to mc squared. Similar formula works in a team, that energy is equal to mission into cash into congratulations. So mission means I have a challenge and I'll fulfill that. Congratulations means it is being appreciated. Cash means it is also being rewarded. So if these three things are there, everybody will look forward to coming to office and his energy will be multiplied. And if this keeps on happening over a period of time and the team members do it with their juniors, I think most people would want to continue to work.
Fabulous, sir. Now we got the secret, how you retain more employees, how you retain more AEM. But here is a question which is coming in from the MFDs. In a trial era, the MFD or RIA does to reduce their cost of operations and increase their profitability. How can they shield their income from this market volatility too?
No, you are saying in the trail era.
In the trail era, how they can shield their income from the market volatility, because even the AEM fluctuates and trial commissions, cost is, we have to bring down the cost. But how you can maintain that income levels.
I think it is important to speak to people in other industries. I mean, if some of your clients or friends are working in the automobile industry, for example, their OEMs want them to cut the cost by 5% every year. And that is compensated by increasing the volume. So quality typically doesn't mean that your cost should go up. Actually, quality should mean your cost should go down, or the productivity or the throughput of your team should increase. I think it is important to realize that these trail commissions will keep on going down over a period of time. So people who work in the computer industry, they find that the prices of computers half every 18 months. So that brings more and more efficiency, more advanced models. So driving costs down is a fact of life. Secondly, we should not think of the commissions as our birthright. What kind of returns are likely to be realized in a particular investment, and how much is the distributor shares, how much is the AMC share within that? This may be a little touchy subject, but I'll take it anyway. If I'm looking at debt funds, for example, when the return is 6% or 5.5%, is a 1.5% expense ratio sustainable? So this is an answer which we can find out for ourselves. And what we have done for the last 5-7 years is we have looked at the debt funds where the expense ratio is less than 0.75.
Right.
But that has helped us to take it to more clients or place it in more portfolios. And we have tried to avoid credit. So that has also helped us, especially in the volatile period in 2020. So it has its own benefits also. But I think when we talk of expectation management for clients, we should also take a mirror test of that expectation management as far as commissions are concerned.
Manage your own expectations, keep that in line. And you gave a right message earlier. How you can scale up your business is the most important. Probably to the paucity of time, I'll have one last question to you, which is asking about what is the new, what are the trends you look forward? You're into the business for 3 decades. In these 3 decades, it evolved so big. But if we are not taking next 3 decades, at least next 1 decade, what you look at, what kind of trend it can evolve, and how MFD need to get ready for it.
Mark Twain has said that it is dangerous to forecast, especially about the future. So with that caveat, I think the Indian middle class is going to grow. I think their saving potential is going to grow, and we also see financialization of savings, which means traditionally most of Indians have been investing in physical assets. You will find that for many of your clients' portfolio, 50, 60, 70% of their overall wealth is in real estate. For average Indians, RBI says that it is possibly close to 80%. So that shift away from physical assets into financial assets has already started happening. Last 2 years, we have seen a big acceleration in that, and I think this is an irreversible trend. So financial savings are going to increase. So this is definitely on the positive side as more people come into the middle class. So and upper middle class. So from 15 crore families to 30 crore families, when we go as far as middle class is concerned, I think they are going to have larger discretionary spends, larger savings, larger financial assets, and provision for retirement. So I think from that standpoint, I see there is a very bright future for people who can help people beat inflation over a period of time. So that is one part. Uh, the cost of managing has to come down. There will be a lot of questions raised even on active management. So what we have seen in US is that now passive investment vehicles are 50% of the mutual fund AUM, and the same thing which is done at a much lower cost. Even within passive, you will find that a number of indices have been created, like the volatility 30, 100 index, or you will find that the high quality index. So you will find factor investing rather than active investing also finding a place in many client portfolios. Uh, with the onset of direct plans, I think more people will also look at direct plans, and many of them may prefer going the RIA route rather than the distribution route. That is definitely a possibility. So, uh, new type of instruments. We spoke about REITs and InvITs, for example. So, some useful instruments also will be introduced into the market. Uh, so, the larger pie, more responsible investing. These are the trends which I think are quite irreversible.
Thank you so much, sir. Indeed, it's always a lot of learning. And that last one, which you gave, the future, which looks very brighter. All of us, what we need to do is we need to evolve and we need to adapt and we need to get ready. And it's the learning is always a way to go. And opportunities are bigger. And as an MFD, as an RIA, the future is definitely there. Of course, challenges are plenty. We can come forward. It's very interesting and very insightful conversation always with you. And it's a lot of learning. I'm sure each of those who are there today, of all the audience and those who are on the social media, would have got the best out of Bharatji's. And what we need to do is we go back and practice a little. And after all, we are in the business of practice management. And rightly put it, it is not the business management, it is the practice management. And practice management will only become better more we practice better. And the practicing can happen as it evolves. And it is that's where we look at. And very nicely put it in the beginning when we are talking about the Peter Drucker. The first question to ask yourself is don't ask how can I be successful, and ask how can I be useful. I think if this question, if we can ask every day, we are there where we want to be. I think Charlie Munger, who said spend each day, you become more evolved from the day in the morning you woke up, and day by day, and if you live for longer, the power of compounding adds to your own life, and your life can become much better. And that's where you can become great business. That's where you look at where the business started in 91 and evolved in 2004 2005, and where it has come in. And somebody said, it's just be sincere and make yourself full effort in each moment. Then there is a time where the nirvana in your practice itself is there. There is, you doesn't need to go out for the nirvana. I think it was a very interesting learning, sir. And yeah, and the USPs which we spoke is fantastic. And today it is not a learning from the masters, but each of it is a masterpiece to build the mutual fund distribution business. And MFD for me, always I look at is you are not just a mutual fund distributor, but you are multi-generational financial distribution. It's a generation after generation. We are here to create the wealth. And I invite Nishant, and I sincerely thank you and thank the audience for their questions. I am very sorry, some of you, Tarun, Loknathan, I could not take some questions because of the paucity of time and larger interest. Nishant, please do come, and it is fantastic questions. And to put it in your cafe mutual language, today's takeaway for me is a cafe CAFE always. That is, build your competency and adapt to the practices which are evolving. Focus on your clients and expand your business with a single mind focus where you can create the wealth for the client. Over to you, Nishant, and thank you so much, Bharat sir. Wishing you very happy journey to Pune, happy and
Thank
safe
you.
journey to Pune.
All right. So we have come to an end to this interesting session. Bharat, thank you so much for such an insightful session. And KS, as always, you did a fantastic job of putting all things in perspective. So finally, I thank each one of you for being such a wonderful audience. Have a great day.
And all the best to you, Nishant, for your Cafe Mutual Fest. It
Thank
is
you.
going to be a hybrid model. Each of the audience, I request, be there with the Cafe Mutual Fest next week. It is going to be a great learning event and festival of learning for all of us that helps each one of us to connect and grow big. And God bless you all. Stay safe, stay healthy, and safe journey to Bharat sir. Thank you so much once again. Thanks, Nishant.
Thank you. Thank you, Bharat and KS. Thank you for your kind words.